Investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. On Fridays, I run this podcast, and the podcast is today called Earnings, Earnings, Earnings. So I run it for about 20 minutes on a Friday. I try and get this up and published before 9 a.m. Eastern Time on Fridays. I've got a very small group of people that watch this, and the people that watch this have been incredibly supportive of me. It's really, really great. It's really motivating. Thank you so much for all that because it's tough, to try and get in front of an audience every week, and it's tough to do this and to grow your audience. But anyway, so thank you so much for everyone that's supporting me. I've got an interesting topic today. We're going to cover a lot about investing as an evergreen topic. We're going to talk about what you should think about when you're looking at businesses and trying to understand what is the multiple that you're paying. We're going to talk about balance sheets, and we're going to try and just unpick with two examples that I'm going to highlight: Amazon and Affirm, two A companies. So it's Affirm, Amazon. Yeah, that's a little joke. Okay. Anyway, my sister probably will be watching this and be laughing that I've screwed this up. Anyway, so it's quite interesting, right? So the first thing that I wanted to kind of highlight here is like just taking this back to basics. Like, what is it really to be a value investor? It's such a thing that people talk about. Oh, like you're a value investor, you're a growth investor. Like, what does it all mean? Because there's a quote here that I've taken from Adam Smith. That's a pseudonym. I think it comes from Moneyball. He talks about. So if you don't know who you are, this is an expensive place to find out. I think the book was Moneyball. It could have been Super Currency, or can't remember. He got two books with George Goodman, a great author. And ultimately, what you're trying to do in investing is really to buy something for less than it's worth. And it doesn't really matter. People like to categorize things and, just to simplify things, because that's what it is, right? In investing, you have to kind of have that pitch down. You have to say, like, what do I explain really quickly, and people want to just kind of pigeonhole you. But what you're trying to do doesn't matter, like what you're trying to do in terms of the time frame. You're just trying to buy something for less than it's worth, ultimately. Something for where the expectations are low relative to the future value when you exit. And in investing, it's tough, right? You're trying to deploy capital into a business, and it doesn't really matter whether it's a low quality business and the share price is low, or it's a better quality business and the share price at the start looks expensive. You're just trying as best as possible to figure out whether the odds are in your favor. And if you start out by buying into an investment where everybody's like really bullish about it, sentiment is really, really high, you need them to really outperform consistently for a while for you to be rewarded. Conversely, if people are kind of like, oh my god, I don't want to invest in that company, it's like, even if like everyone kind of feels, oh yeah, it's a great company, but it's not a good time. That's dead 6 months, like that time. You might as well go somewhere else. Those are also good investments. And typically, if you're trying to align yourself into a high quality business that has high returns on invested capital, and looks like there's reasonably good margins on the horizon, and that the margins are sustainable, those are typically good investments to have. Now, the problem is that people kind of understand the basics, but they haven't got the stamina to see it through. So just to decompose what it takes to grow your capital over time. Yeah, there are three variables to invest in, okay? There's your starting capital, there's your rate of return, and there is how much you add time to it, okay? So starting capital, you haven't got a lot of wiggle room there. You're kind of starting out as a sum. You can't do much about that. The rate of return, frustratingly, it's going to be kind of limited. I say to people, work towards 15%. If you get, let's say, 10%, it's not the end of the game. But that's not very much in your control. The only thing that is in your control is the time that you spend investing. Now, in the long run, the longer you're invested, the better your returns. But in the long run, we're all dead. So you need to kind of balance that out slightly. You need to be able to kind of think it through and say to yourself, okay, I want to play the 20-year game, but I want to stay with the companies for a slightly longer period of time, because the last 2-3 months have been really visceral in the market, in the space that I follow, which is kind of like mid small cap tech stocks. It's been really, really difficult. But this is not representative of what it's always like. And people are extrapolating how it is right now into the future. And people have a lot of this recency bias, coming out of 2020, everyone was like, oh my God, this is like a tech. And there was like, things just went berserk and people were extrapolating then. And now people are extrapolating now. So ultimately, there was a lot of pull forward in a lot of these businesses. A lot of these businesses that had different dynamics, whether it's, let's say, advertising businesses that coming into 2021, they had the very easy comps against 2020, the early part of 2020, and revenue growth was really, really strong. And you also had a lot of people that kind of still in that restricted travel, let's say, not necessarily stay at home, but there were a lot of people restricted at where they could really go and spend time. So people were looking at those run rates at the early start of 2021, and people were kind of thinking that is the new normal, and they didn't really understand that much. And even though I was kind of trying so hard to kind of explain that to a lot of people, it for so long in investing, it's kind of like you have this vision of things, and you feel like, oh my God, this is the truth of the matter, that these businesses are going to be more volatile, and you can see that they're more volatile, but the market is not picking up on it, and you'd start to doubt yourself, and you start to believe that you're the one that's in the wrong, and you just and this is human nature, and that's why investing is such a great sport, because it's always kind of tricking you. It's always playing on your mind. And the one thing that I find quite interesting, it was a quote from Buffett. I think he made it in 2015 or 16, might have been 2018. It was for the Financial Times. He doesn't do those many interviews nowadays with quote unquote fresh quotes. He doesn't do those many. A lot of the Buffett quotes are like things that he does that have just kind of become evergreen topics. But the one that he said that was quite interesting is that you can teach people all you want about Graham, and they can become really, really smart, but they won't become wiser. And that when there's fear in the market, there's fear. And at the time, 2018, I remember there was not a lot of fear. Things were quite stable. Q4 18 was quite rough, but when that quote came out, there wasn't a lot of fear. And I thought at the time, that's interesting. I'm going to keep this quote because at the moment there's not a lot of fear. But as we kind of look in time, there's going to be a period where things are going to go really, really berserk and really, really crazy. And I'm going to come back to this quote. And now I'm looking at this quote quite on a frequent basis, because it's not difficult what you're trying to do. You're trying to buy something for less than it's worth, and you're just really trying to have the stamina to see it through to the other side. And everyone has this idea that right now, results are coming out and many stocks are getting obliterated, and people are like, oh, like I'm going to dump this investment. Like, you're just kind of giving into the emotions of the situation, and things will calm down. I tell you for certain, things will calm down. There was a bit of an abnormal period. COVID was an abnormal period. There's a lot of businesses that were well disposed to benefit from that period. They pulled forward a lot of those revenues, and the multiple expanded, people extrapolated, and now that they're comping that period, things are slightly more difficult. But those businesses are still strong businesses, and they're going to be around for the next 2-3 years. And provided that you're not paying a heroic multiple, you're gonna do quite well. And what I'm trying to explain is that don't believe that this is how it's going to continue for the next 2-3 years. The risk reward right now is really, really compelling for a lot of these businesses. And even if you haven't got a great business, and even if the valuation isn't particularly great, just stay with the business. If you've only been with the business for 6 months, just give it a little bit of time, Okay, pressing on. So I've already kind of alluded to this, but I don't like earnings seasons. I really don't like earnings seasons, right? Because it's high pressure. right? I don't know about you, but for me personally, I don't sleep well during earnings season. There's a lot of pressure to on the companies, a lot of pressure on how people react to stocks, and there's these wild swings ups and down. It's like, oh, it's up 10%, and everyone's like, oh my god, is this a buy? Is this a buy, hold, sell? And when stock falls, it's like, oh my god, sell. Like it's just so crazy, right? And you know how a business does over a 90-day period, and particularly in the next couple of hours after the results come out, is not a vindication of your hard work. Very little of your hard work is being reflected in those post earnings reactions, and you just kind of get yourself into the frame of mind that you have to be able to be the owner of the business for a period of time, okay? And just give it time, and don't become overwhelmed. Don't try and kind of buy at the lows and hope that next quarter you're going to come out with a gain. And a lot of people kind of, okay, I bought low and now I'm got a 50% gain. What shall I do? What shall I do? It's like, just you'd be so much better in terms of your returns if you just say to yourself, I'm going to buy and I'm going to stay with this company for a year, and I'm not going to be buying too aggressively at the beginning, because a lot of things will come out in the next year, and I don't want to become overwhelmed. If the stock sells off another 50%, I don't want to kind of be in a position that I'm anxious, and I don't want to kind of leave myself too little space to average into the position. Okay, so be led by the time in the business, not trying to time the business, not trying to time the stock. It's time in the market, not timing the market. Another thing that I think is quite interesting is this is, I'm probably picking on a company here, but this is just an example. I mean, what I've seen in the past week. People don't spend enough time thinking about the balance sheet of the company. So the company that I'm talking about right now, and I'm sorry if you own this company and you're super bullish this company. I know that some people are, but I just want to kind of use it as an example. You can take it or leave it, like any of my comments. The company I'm talking about is Uber, and man, I look for this balance sheet. I'm like, oh, that's a tough one. And people don't think about balance sheet. People just think about the ongoing business and the capabilities, but you as the owner, as a stakeholder of the business, you will get paid from the free cash flow that the business makes, okay? But before you as the shareholder of the business gets paid, the credit holders will get paid first, okay? So the first people to get paid, obviously, is the part of the company's the employees of the company, obviously. Management will get paid, and then also think about the credit holders, okay? So in the case of Uber, it has like something like approximately 9 billion of debt. So, and the debt is carried at high single digits, the interest rate on that. So the debt holders are getting a very satisfactory return for minimum amount of risk, okay? So that's one thing. So thinking about the balance sheet in terms of the debt holders, and then thinking about other little niggly bits, like not necessarily in the case of Uber, it doesn't have any pensions, but some businesses do have pensions. In the case of Uber, it has a lot of insurance liabilities. So that is still some cost that will have to be taken out of the business over time. Those liabilities need to be covered at some point. So you got debt to think about. You got, in the case of Uber, off balance sheet debt. Then you got to think about the pension, not sorry, the pension, the insurance liabilities, and then you got to think about management's stock-based compensation. So after all that, because stock-based compensation, yes, it is added back in the free cash flow, but you got to think about that is being incorporated into the market cap. So there's a lot there to think about before you, as the shareholder of the business, are going to actually see a return. And I just think to myself, wow, like a lot of people not thinking about this kind of stuff, and that's fine for a while, but at some point, the market is quite accurate over a reasonably, let's say, 3-5 year period, and you don't want to be left in a position that you bought in to kind of make a quick swing, and your short-term investment becomes a long-term investment because things started going wrong, and then you kind of a year down the path, and you're like, okay, Do I buy? Do I sell? Do I hold? You don't want to leave yourself with that room because, for example, I own Upstart, and Upstart is down 70% in the last 6-7 weeks, and like I'm not cool about it. I'm kind of annoyed that it's gone like that. Mark Minervini was like on CNBC saying, "Oh, I'm gonna buy this company," and like everyone's like, "Oh, buy," and then that kind of popped, and Mark Minervini and everyone that follows him kind of sold, and then the stock went into obviously December. December, high tech just got torched, and I'm down, and you know, like it's not great, but I'm thinking myself, okay, it's not the end of the world because I really want to own this company for a while. It's a company that I believe, not investment advice, but I believe that it's a reasonably good company, and I'm just thinking to myself, yes, in the short term, I've kind of been hit around a bit, but I really want to be the owner of this business, and that gives me the stamina to see it through. If you own something like Uber and it comes down 70%, you're like you think yourself, is it going to come back up? And that's just something that I wanted to kind of share with you. Okay, so kind of pressing on for time here. So thinking about the multiple that you're paying on a stock. So a lot of people kind of talk about this, right? Amazon's business, the advertising business. Everyone's like, oh my god, Amazon's advertising business is like the third biggest advertising business in the world, and it's like if you put a multiple on that, that's just such a high growth business. If you're gonna buy Amazon, you get Amazon. It's not that they can spin off that advertising business. It's not that you can just stick a multiple on that and you take out the commerce business. It's part of the commerce business. It's an integral part of how they compose the margins of the e-commerce business. Yes, please. I mean, it's just common sense, right? And a lot of people are like, oh, AWS is like, oh, AWS is amazing. So AWS, it's a really capital intensive business, okay? And you get a lot of operating margin, but you having to get all the technology continuously because it's high tech business, right? You have to have the technology to continue to upgrade the cycle. You have to have loads of servers. You have a lot of technology to cool down those servers. It's just like it's a high capex business, and it's tough. And a lot of people kind of think, oh, AWS, if you just take a multiple on that and look at other cloud stocks and how other cloud stocks are doing, like it's tough. And if you think about it, it's going to get even tougher because the ability of Amazon to as businesses become increasingly fragmented and specialized, the ability of Amazon to be able to service every single part of the total addressable market continues to compress over time. And I already discussed this in last week's podcast. They're actually losing market share to the likes of Google and Azure. So when people think about Amazon is only priced at 5 times sales, it's like you gotta kind of think about that. Yes, it is priced cheap, but to get a conviction there, you need to kind of think through what you get in underneath the hood as well. Another stock that I'm not so bullish about is Affirm, and Affirm just reported the results last night, and Affirm's is it's a terrific product, right? But if you look through its financials, the way that it has its revenues, and then it has revenues less the transaction costs. So what you're actually getting in terms of when you pay 16 billion or whatever for Affirm, it's like you got to think about the underlying lines of what you actually get in terms of the revenues after all the costs, and then obviously you got the stock-based compensation that is just heroic, and then they to get themselves installed on other platforms. They, for example, with Amazon, they had to give them I think it was 22 million shares, and like it's just you got to think through and understand when you're shareholding these businesses, like what you're actually getting in terms of future free cash flow. And I know that it's kind of boring to kind of discuss these kind of things, but if you look through it and you say, okay, the business's path to profitability is so far into the future that you having to pay a large multiple. Let's say I estimate that if a firm grows next year by 35% year over year, so their fiscal year finishes in the summer. So if you look from that point into the following year and they grow at the time at 35% year over year, you're getting 800 million in revenues. And at 800 million revenues, the stock is priced at approximately 20 times next year's forward sales. And I'm just kind of thinking myself, okay, so do I get a multiple expansion, a meaningful multiple expansion from here? It's a heavy multiple expansion for a meaningfully unprofitable stock. So it's a tough one. I mean, it's really, really tough. I've seen like countless high growth stocks, the multiple can just compress so quickly. And then you're left thinking to yourself, okay, yes, I did buy a leader and this is a founder led business, PayPal, mafia, blah, blah, blah. But when the multiple compresses and goes against you and you're kind of doubting yourself, then you're just hoping for it to kind of come back to break even. Anyway, I wanted to run this for about 20 minutes and I'm kind of coming to the end now. I wanted to say thank you very much for everyone that kind of joined me and supported me on my effort to do this. Please drop me a like below. That really motivates me to come back on a Friday and, to try and give some insights to you all. And also, what I'm going to say? Don't forget to check out my marketplace. It's called Deep Value Returns, above the screen right there, right? We've been watching it this whole time. Come over and do a trial, and yeah, I hope that you'll drop me a line and check out what other people said about my marketplace, check out the reviews, and yeah, I hope to see you next time. Thank you so much for your help. See you soon. Bye bye.